This is a day trading strategy, which means we open and close our positions within the same trading day without holding them overnight. To use this strategy effectively, you first need to understand the core principles of smart money concepts. These principles form the foundation of the trading system, and your success depends on applying them correctly on the chart. Before we break down the strategy, let's quickly recap these concepts. Let's start with supply and demand. Supply and demand zones are areas on the chart where large numbers of traders enter the market, causing the price to move away aggressively from that level. These zones often indicate areas where buying or selling interest remains, providing valuable trading opportunities. Normally, we mark the starting point of a strong price move as a supply or demand zone. When the price returns to that area, we expect it to react because, for whatever reason, traders were very active there in the past. However, not every supply or demand zone is worth trading. To identify strong zones, we look for three important factors: inefficiency, break of structure, and the distance price moved away from the zone. These factors help us measure the strength of the zone and increase the probability of a successful trade. Inefficiency occurs when the price moves away from an area very quickly, leaving an imbalance between buyers and sellers. This imbalance often appears as a fair value gap between candles. A fair value gap suggests that the price moved too fast and did not spend enough time trading at certain levels. Because of this, price may return to those levels in the future, making the demand that caused this gap an important area to watch. A break of structure occurs when price breaks the recent market structure level to the upside in a bullish scenario. This shows that buyers are still in control, and the current trend is likely to continue. The pushed distance refers to how far the price moves away from a zone before returning to it. The further the price moves away, the stronger the rejection is considered to be, which can make the zone more reliable. By combining inefficiency, break of structure, and pushed distance, you can identify stronger supply and demand zones and focus on higher probability trading opportunities. In this example, the latest impulsive movement meets all the criteria for a high-quality demand zone. It has created a fair value gap, broken through the previous market structure, and pushed the price higher by a significant distance compared to previous moves. Once the price retraces back to this demand zone, there is a higher probability that it will reject the area and continue moving upward. But what happens if price breaks and closes below this high-quality demand zone? This brings us to the next smart money concept: the change of character. In the previous example, breaking below the demand zone would indicate that buyers have failed to hold the level and sellers have taken control. This signals that the uptrend is over and a potential reversal is underway. When price breaks through a strong level like this, it suggests that the market structure has shifted and momentum is now favoring the sellers. This condition is known as a change of character and signals a shift in market sentiment. However, the change of character is valid except in two common scenarios. In certain market conditions, they can become invalid. This usually happens during imperfect trending conditions, where price forms a change of character but continues moving in the same direction. This often confuses traders who believe the trend has ended and that a reversal should follow. Let's break this down step by step. In this example, we have a swing low that led to this breakout. A break below this level may appear to be a valid change of character. However, if you look to the left side of the chart, you'll notice something important. This level aligns with a significant liquidity area. Many traders previously entered long positions at this level and placed their stop losses just below it. As a result, a large pool of liquidity has formed beneath that swing low. This liquidity becomes an attractive target for smart money. To target these stop losses, they often push prices lower, sweeping the liquidity before driving it back up in the same bullish direction. The key takeaway is that when a major swing low sits within a liquidity area, a break below that level is often just a liquidity sweep rather than a true market reversal. In this situation, we cannot classify the break as a valid change of character. If price re-enters the range after sweeping the liquidity, it can provide an excellent long opportunity. The reason is simple. The overall trend is bullish. The sell-side liquidity has been taken out, and the next objective becomes the buy-side liquidity. As smart money traders, our goal is to enter after the stop losses have been swept, when the real move is likely to begin. Now that's only one piece of the puzzle. Let's discuss another concept that can invalidate a change of character: mitigation of fair value gap. Identifying fair value gaps should be one of the first steps in your chart analysis, because these areas often act like magnets for price. In many cases, before continuing its trend, the market retraces to fill these gaps. This is why fair value gaps are important zones to monitor. They tend to be most effective on intraday timeframes, such as the 4-hour, 1-hour, and lower timeframes. Now, here's where it gets interesting. Let's go back to the previous example. If you look closely at the left side of the chart, you'll notice an unmitigated fair value gap sitting just below the major swing low. In situations like this, price will often retrace into the fair value gap to fill the imbalance before continuing in its original direction. This pullback does not necessarily indicate a true reversal. Instead, it is simply the market rebalancing itself. The key takeaway is to always check the left side of the chart for unfilled fair value gaps. Doing so will help you distinguish between a move that is simply filling an imbalance and one that reflects a genuine shift in market sentiment. By understanding this difference, you can avoid false signals and stay aligned with the overall market structure. Now that we've covered these concepts, let's move on to the next topic: